Imagine two people earning exactly the same $80,000 a year. Same city, similar lifestyle, similar responsibilities. 10 years later, one has a six-figure investment portfolio, while the other is still wondering where the money went. The difference usually isn't a huge mistake. It's the small financial decisions that became automatic. A car financed too often, a mortgage that stretched the budget, fees nobody checked, insurance nobody compared, cash sitting idle, investments that cost more than they needed to, lifestyle upgrades that happened every time income increased. Individually, none of these decisions looks dramatic. Together, they can quietly redirect tens of thousands of dollars away from your future. So instead of talking about extreme frugality, let's look at 10 financial leaks that can be measured, challenged, and fixed. The first is housing. Housing is often treated as a fixed expense, but it is actually one of the biggest financial decisions you make. Suppose a household earns $120,000 and chooses a home that requires $3,200 a month for mortgage, taxes, insurance, and basic ownership costs. Another household with the same income keeps that total closer to $2,400. The difference is $800 every month. That's $9,600 a year. Over 10 years, the raw difference is $96,000. And there's an opportunity cost. If even part of that difference were invested consistently instead of absorbed by housing, the long-term gap could become dramatically larger. The important lesson isn't buy a cheap house, it's that every additional dollar committed to housing becomes a dollar that cannot easily be used somewhere else. A larger home may provide more comfort, but it also purchases a larger permanent obligation. The second leak is lifestyle inflation. Getting a raise is supposed to improve your financial position. But if your income rises by $10,000 and your lifestyle immediately absorbs $8,000 of it, your salary increased more than your wealth-building capacity did. This happens quietly. A nicer apartment, a newer vehicle, more restaurant meals, premium travel, more convenience services. None of these purchases is automatically irresponsible. The problem is automatic upgrading. A powerful rule is to decide in advance where your next raise goes. For example, if income increases by $10,000, perhaps $5,000 goes toward investing, $2,000 toward debt reduction, and the remaining $3,000 improves your lifestyle. You still enjoy the raise, but your future benefits from it too. Third is cash sitting in the wrong place. Keeping an emergency fund in a checking account may feel safe, but large amounts of idle cash can lose purchasing power over time. The solution isn't to invest your emergency money in risky assets. It's to separate money by purpose. Short-term emergency reserves belong somewhere liquid and relatively stable, such as an appropriate high-yield savings account. Long-term money has different requirements. If money isn't needed for years, keeping all of it in a low-interest account can create another opportunity cost. The mistake isn't having cash. The mistake is treating every dollar as if it has the same job. Fourth is ignoring taxes. Many people focus intensely on investment returns while paying almost no attention to the tax structure surrounding those investments. But a return isn't the same thing as what you actually keep. The United States gives investors several tax-advantaged accounts, including 401ks, traditional and Roth IRAs, and health savings accounts for eligible individuals. The details vary by person, but the principle is straightforward. Don't choose an investment strategy first and think about taxes later. Think about both together. A portfolio earning a strong return can still be inefficient if its tax treatment is unnecessarily expensive. Fifth is paying interest while trying to earn investment returns. Imagine someone carrying a credit card balance at a very high interest rate while simultaneously investing small amounts in the market. It may feel productive because an investment account is growing, but mathematically, expensive revolving debt can work against you much faster than expected investment returns can compensate for it. This is why the interest rate on your debt matters. A guaranteed reduction in a high-interest obligation is fundamentally different from hoping an investment will outperform that cost. The exact decision depends on the debt, taxes, liquidity, and your overall situation. But ignoring the interest rate is a mistake. Sixth is paying for convenience without measuring its annual cost. One delivery fee doesn't feel significant. Neither does one premium app. Neither does a paid membership. Neither does a service charge. The problem is accumulation. Suppose 10 small conveniences cost an average of $18 a month. That's $180 monthly, more than $2,000 a year. The solution isn't eliminating every convenience. Instead, calculate the annual cost. A $12 monthly service isn't really $12. It's $144 per year. A $35 monthly membership is $420. Once expenses are expressed annually, unnecessary commitments become much easier to recognize. Seventh is buying insurance based only on price. Insurance is one area where the cheapest option isn't always the smartest option. The real question is whether the coverage protects you from a financial loss you couldn't comfortably absorb yourself. For auto, homeowners, renters, disability, and life insurance, compare premiums, deductibles, limits, exclusions, and the actual risk being transferred. The goal isn't maximum insurance, it's appropriate protection. Underinsuring a major risk to save a small amount each month can create a financial disaster that wipes out years of saving. Eighth is failing to negotiate recurring bills. Many households review investments once or twice a year, but never review the services that automatically charge them every month. Internet, mobile plans, insurance, bank fees, professional services. Some bills can be reduced simply by asking what alternatives are available. Even a $50 monthly reduction becomes $600 a year. Over several recurring expenses, the number can become meaningful. And unlike an investment return, the savings from removing an unnecessary fee are immediate. Ninth is confusing complexity with sophistication. A complicated investment portfolio isn't automatically better than a simple one. In fact, complexity can make it harder to understand what you own, what you're paying, how much risk you're taking, and whether your investments actually match your goals. For many long-term investors, broadly diversified, low-cost investments can provide a straightforward foundation. The key isn't finding the most exciting investment. It's building a system you can understand and stick with through market cycles. That's where behavior becomes more important than prediction. You don't need to correctly predict every recession. You don't need to identify every winning stock. You need a process that prevents temporary market emotions from controlling permanent financial decisions. And that leads to the 10th leak: waiting for the perfect time. People often tell themselves they'll start investing after the market falls. They'll save after the next raise. They'll pay off debt after the next bonus. They'll organize their finances when life becomes less busy. But financial progress rarely begins when life becomes perfectly convenient. It begins when a system is created despite imperfect circumstances. Automate contributions. Automate bill payments. Increase retirement contributions when income rises. Review recurring expenses periodically. Keep an emergency reserve. Attack expensive debt. And give every major financial goal a specific destination. The power comes from repetition. Consider someone who invests $500 every month for 20 years. That's $120,000 contributed. At an illustrative 8% annual return, compounded monthly, the account would grow to roughly $295,000 before taxes and fees. The return isn't guaranteed. Markets don't move in straight lines, but the example demonstrates something important. Wealth is often built through ordinary decisions repeated for a long time, not through extraordinary financial predictions. And here's the bigger idea behind all 10 mistakes. You don't necessarily need to completely redesign your life. You need to identify the decisions that repeat. A one-time $500 purchase matters. A $100 monthly leak can matter much more because it keeps happening. A recurring decision deserves recurring attention. So take your last 3 months of bank and credit card statements. Don't start by asking, what can I cut? Start with 3 better questions. What am I paying for repeatedly? Which expenses no longer provide enough value? And which dollars could be redirected towards something that matters more? Then look at your housing, transportation, debt, taxes, insurance, subscriptions, banking, and investments. You may discover that your biggest opportunity isn't earning another $10,000. It may be keeping more of the money you already earn. That is the part most financial advice misses. Building wealth isn't only about making more money. It's about reducing the number of places your money disappears without creating enough value in return. Because when you control those recurring decisions, something powerful happens. Your income starts working harder without necessarily increasing. Your savings rate improves. Your investments receive more capital, and time begins working on your side. That's how small financial decisions become large financial outcomes. If this video helped you see your money differently, hit the like button, subscribe for more practical finance content, and comment below with the one financial expense you're planning to review first. Thanks for watching.